Hey yo, what's up everybody? Good day to you all, ladies and gents. Welcome back to Matrix Investing, the number one YouTube channel that is dedicated towards giving you education based on investing in capital markets. Now in this video, we're going to look at the financial metric known as the earnings yield. We're going to look at what it is, its usefulness to investors, and the challenges behind using it, as well as how it can be applied on an actual company. Now if this is the very first time you're watching our videos, we advise you to check out our previous videos so that you can have a better understanding of what exactly we're teaching. If you also find this video useful, by all means, please like this video, subscribe to our channel, and click that notification bell so that YouTube gets to notify you each time we get to upload videos into the platform. Now, with that said, ladies and gents, let's get down to business. So, starting off by figuring out what the earnings yield is. So this is a financial metric that shows the relationship between the EPS, the earnings per share, and share price of a company. This metric is the inverse of the P/E ratio, and it is used to show returns of profits on the share price. Alright, so technically the earnings yield is the inverse of the P/E ratio. And instead of showing how many times larger the capital you would invest in a company is in comparison to its profits, this ratio shows how much of a return would you get as profits by investing a certain amount of capital, all of this being on a unit share perspective. So investors who use this type of ratio are the ones that usually consider investment income over capital appreciation, of which the capital appreciation is mostly observed in the P/E ratio. So using the earnings yield to check out profit returns on capital invested is a major concern for investors who are obsessed with the income their capital has potential of making. However, remember, on the capital invested, an investor won't get the full profits directly, as some of it would be reinvested back in the business to enhance further growth and get dividend returns, which are obviously less than the earnings yield. So stocks with higher earnings yield attract investors because the price of purchasing shares is small and that the business is able to make better returns through profits. But stocks with a lower earning yield are often left out by investors because the price for purchasing shares is large and that business is making lower returns to profits. The bigger the earnings yield, the better. Capital is invested, more profits being made as returns. The lower the earnings yield, the worse, because less profits is being made as returns on the original capital invested. Other uses of the earnings yield is helping an investor compare returns of individual shares as well as that of other assets such as bonds in order to figure out which assets have the greatest returns and provide asset allocation. So the earnings yield helps an investor compare individual stocks from different economic sectors to see in which sector is there an opportunity to get the greatest returns as profits on capital invested. An investor can also go further by comparing different asset classes such as bonds and real estate to see where there is greatest returns and use that info to perform asset allocation and figure out where they should invest more money to make the best returns. So then to clarify this brief explanation right here, we're going to use the example given below. So then there's three different investments, two of which are stocks of different companies from say different sectors, and the third one being bonds. So shares of the CBA company having an earnings yield of 15%, shares of the Pakua Pakua company having an earnings yield of 23%, and corporate bonds of Sabua company that pay a coupon rate of 19%. So then out of these three investments, the one that shows greater returns is the Pakua Pakua company because its earnings yield is as high as 23%, followed by the corporate bonds of the Sabua company, which provide an interest payment of 19% on capital invested, and shares of the CBA company that have an earnings yield of 15%. So then an investor is able to figure out which individual investment can provide the greatest returns on the capital invested. And using that information, an investor is able to allocate his or her capital more efficiently. That is, invest more where there is more likely chance of getting more returns and invest less in places where there is less returns. So we can see how the earnings yield is very useful for comparison as returns are measured in percentages as a standard unit to compare several investments in terms of returns, of which also are represented in percentage. So the investment with a larger percentage wins. Challenges of using the earnings yield. Challenge number one, it doesn't show a clear picture of the actual amount of money that an investor is going to pocket. Because out of that profit that has been attained by the business, there's some of it that is going to be reinvested into the business, and there's some of it that is actually going to be paid out as dividends. So the earnings yield shows two returns combined, one that an investor can feel directly as dividends, and one that an investor can feel directly as reinvestments into the business. But these reinvestments into the business also do benefit an investor in a way, as it allows the business to grow and put itself in a better position in the future. Though investors do need to realize whatever they get as earnings yield isn't everything they're going to see in their bank account. Let's just get real there. So challenge number two, one-time huge profits could cause the business to record very high earnings yield within the short run than what it normally makes. So you have to be really, really careful with this. There are times where a business could be feeling really lucky and could end up making very high profits, as a result, inflating the earnings per share. So for this, you have to rely on a 10-year analysis and checking out how the profits have been doing throughout the time. If you're going to rely on the inflated EPS, it's going to get extra risky, because you could either be looking at the new normal of things, that is the new normal of how the business is going to be making profits from there on out, or one-time wonders, or things that are going to drop where they were or even worse. So here's the formula for the earnings yield. We first take the earnings per share divided by the share price and multiply it by 100%. So then let's see how we can use this on an actual company. All right, ladies and gents, so here we all are in the annual report for the DSE, the Dar es Salaam Stock Exchange, as of the financial year of 2019. So the reason why we've opened this annual report is so that we can figure out what the earnings per share was as far as the latest annual report was released by the company. So right here, we can see that the earnings per share is 148.92 Tanzanian shillings. So we're going to use this earnings per share and divide it by the share price of DSE. So I am just going to go to the actual equity daily prices for DSE as of the 10th of December. Mind you that today is the 11th, but this is the report for the 10th, and the reports are usually given out by the DSE when the market is closed. So since the market ain't closed yet, we will not have the market report as of this particular time. So I'm just going to use the ones for yesterday, and we can see right here there is DSE that is highlighted over here, and we're going to use the closing price, that is the price of each DSE share by the time the market was closing. So I'm just going to pull out my calculator right here, and I'm going to take 148.92, and I'm going to divide that by the latest price per share, which is 880. And from there, we should see a 0.16922, all that stuff. So I'm just going to multiply that by 100%, and that should give us 16.9227, 16.9%. If you want to round it off to 17%, well, that's okay with you. So then the earnings yield for the DSE, by the way, the DSE is the Dar es Salaam Stock Exchange, and yes, it self-listed itself. So then the earnings yield for the Dar es Salaam Stock Exchange is 16.9%. Now, how is this information any useful to you? Well, you can compare this to a bunch of other individual stocks or other assets of which you find interesting to invest at, and you can compare the returns. And if this return seems to be very attractive in comparison to the other assets or the other stocks, then you should probably prioritize to invest in the DSE as compared to other companies. With that said, ladies and gents, thank you so much for watching this video to the very end. If this video has been useful to you, then we ask that you help us by hitting the thumbs up button, like the video, subscribe to our channel, and hit that notification bell so that YouTube gets to notify you each time we get to upload more videos like these into the platform. Share this video to your buddies. Sharing is caring and knowledge is power, so that they can also benefit from this video just like you. If you're on social media platforms, Instagram, Facebook, and Twitter, Don't forget to check us out there. Our account name is Matrix Investing. The links to our social media accounts are in the description below. We provide content related to investing in the Tanzanian capital markets on a daily basis. So don't forget to follow, like, share, and comment. If you also have questions or opinions to contribute, you can do so on the comment section below or DM us on our social media accounts. Anyways, so thank you all so much and have a great day.